Take a look at your stock portfolio. Some of your stocks are on profit and some are losing. So, which ones should you sell and when? If you act on impulse, you might believe that it is best to sell your winners and hold onto your losers, right? After all, you're banking profits and also you're giving those underperformers a chance to rebound. Well, you're probably making some mistakes here and you need to fix it. You see, the intuitive approach is often the opposite of what successful investment requires. Just think of it like this. Would you cut the flowers from your garden while nurturing the weeds? Probably not. Yet, that's what you're doing when you're quick to sell your winning stocks, to bank your profits, and slow to let go the losers. Money Arata. Selling winners and holding on to losers is a common mistake that many investors make, often due to an emotional investing or due to a misunderstanding of portfolio rebalancing. But in doing so, they're cutting short their potential profits and they're prolonging their losses. So, what should you be doing? The first step is to let go the idea that you should never sell a stock at a loss, never realize your loss. Sometimes selling a losing stock is the best decision that you can make. What about the winners? Well, maybe they have even more room to grow. To be able to stop making these mistakes, the first thing you have to do is to know how to create your own strategy. You need to identify when it is time to sell both winners and losers, and you need to make these decisions using less emotion and more strategy. Now, attention, this is not financial advice. Please read the full disclaimer before proceeding. You need to understand the psychology of investing, and this is how you know the reason why you keep holding losing stocks. Open your portfolio and take a look at the stocks that you're still holding in loss. Why are you doing this? Well, there are a few emotional, psychological reasons. The whole emotional journey typically has the phases of hope, denial, fear, justification, despair, and acceptance. Hope is the spark that ignites your investment journey, but don't let it blind you to the reality of a poor performing stock. When you first realize that one of your stocks is underperforming, you might believe that it is just a temporary setback. Because you look at the past performance and you think, well, it was pretty high before, it's down now, but it can go high again, right? The company had good fundamentals when you invested, so you hope that it will bounce back soon. Denial is the investor's mirage. It makes you see value where there is only loss. Now remember, facts over feelings. So use denial as a sign to cut your loss. As the stock continues to underperform, you might find yourself in denial. You might dismiss negative news or poor earnings reports, just focusing on the positives. You might convince yourself that the market is just overreacting, that the stock is undervalued. And you might start to blame external factors such as the economy, the market volatility, some political situations. But remember, all these factors also affect other companies as well, and some of the other companies keep going higher and higher. The moment you realize that you are under denial, make sure to cut your loss. Fear is like quicksand. It can trap you in poor decisions. Embrace it. Learn from it. But don't let fear control your investment strategy. When your stock's decline continues, fear starts to creep in. You start to worry about the potential loss. You fear selling at a loss, thinking that it would mean that you failed, you made a mistake. Just the thought of selling feels like you're admitting defeat. That is a tough pill to swallow. Justifying a losing stock is like adding more water to a sinking ship. It is not the loss that you need to justify, it is the decision to hold on. So during the justification stage, you try to justify holding on to that losing stock. You might be thinking something like, well, I haven't actually lost anything until I sell. You might convince yourself that you're a long-term investor. These short-term losses don't really matter to you. You might start viewing that lower stock price as a discount, thinking that it could be even a good opportunity to buy even more shares. Then comes despair. Despair is the dark before the dawn. It's one more sign to cut your loss and refocus on more promising ventures. If the stock continues to fall, despair sets in, and at this point, you might feel stuck. Because you've held onto that stock for so long that taking a loss now would mean that all that time, all that emotional energy was wasted. You feel like you've lost control of the situation. And finally, acceptance. Acceptance reminds us that it is not about winning every time, it is about learning from losses and making better choices next time. Eventually, you might come to accept the loss. You realize this stock is not going to bounce back. Holding on to it is just causing you more stress and potential financial harm. You finally decide to sell, often vowing to learn from this experience and not to repeat the same mistake. Understanding all these emotions can help you to recognize when you're holding on to a losing stock for emotional reasons rather than logical ones. It is crucial to separate emotions from investment decisions and base those decisions on a solid financial analysis and a well-defined investment strategy. In the end, remember that investing involves wins and losses. And what matters is that the wins outweigh the losses over the long term. This is what we teach in the Diamond Hands training, which you can unlock right now by visiting arata.se/Diamond Hands. Don't marry your stocks, especially if they are poor performers. You might hold on to a losing stock because you're emotionally attached to it, even though all the signs point to the continued decline. That is why it's so crucial to not marry your stocks. So when we say that don't marry your stocks, it means don't get so emotionally attached to that stock that you just can't let it go. Even when it's pretty clear that it represents a weed in your garden. So how can you tell if a stock is a weed? Well, here are a few indicators. Number one is poor financial performance. If the company consistently reports poor financial results like declining revenues, falling profits, increased debt, it could be a weed. Bad industry outlook. If the industry in which this company is operating is facing significant challenges or has a bleak outlook, it could also affect the company's future prospects. Management issues. Frequent changes in the leadership, ethical issues, poor decision making, they could all be signs of deeper problems within the company. A falling stock price. See, while short-term fluctuations are normal, a long-term, consistent drop in the stock price might suggest that the market has lost confidence in that company. Cutting dividends. If a company has historically paid dividends, suddenly cuts all these dividends, well, it could also be a warning sign. Now remember that investing should be guided by logic, not by emotions. So don't let an emotional attachment to the stock prevent you from making sound financial decisions. If the stock is a weed, it is okay to let it go. Do you practice portfolio rebalancing? If so, you might be making a common mistake. Portfolio rebalancing is a sound principle. It is the strategy of realigning the proportions of your assets. This maintains the desired level of your risk balance, your asset mix. It is just like having a regular checkup for your investments. You make sure that they are still in sync with your financial goals. But here's the catch. You could be going off track if you overlook the crucial element of the fundamentals. Many investors get caught up in the numbers game. They see their successful stocks, the blooming flowers, taking over their portfolio. They represent a bigger part of their portfolio, so they cut back on some of these winners. And then they buy more of the underperforming stocks, the weeds. They aim to restore the original balance, but they're missing here a key step. Their rebalance is based only on the numbers. They don't consider the fundamentals of each asset. Now remember that the market conditions can change. A company's performance, when you first define your portfolio balance, it could be different now. A underperforming stock today might be underperforming for a good reason. Maybe the company's financials have weakened, or the entire sector that it belongs to could be facing challenges. So if you buy more of that weak stock to rebalance your portfolio, you're adding more weeds to your investment garden. So here is a better approach. Always reveal the fundamentals before you rebalance. Because if your flower stocks are still fundamentally strong, they might be worth holding on to. They might have some robust financials, promising growth prospects. But if your weeds are struggling, well, that could mean that they have weak financials, a problem in the entire sector. In that case, it might not be worth buying more of those weeds, no matter what type of balance you want to have in your portfolio with those weeds. So in summary, don't just rebalance, rethink. Look beyond the numbers, revisit the fundamentals. And remember that investing is not just about maintaining a balance, it is about growing your flourishing garden of assets. Selling stocks should not be driven by fear or greed, but by a clear understanding of your investment strategy. Don't just impulsively sell your winners. Instead of that, let them bloom. They might have even more room to grow. And don't hold onto your losers out of hope or denial. Just like you would weed out a garden, weeding out your losing stocks from your portfolio to protect your financial health is the way to allow for growth. In our Diamond Hands training, we give you a detailed strategy to minimize your losses and maximize your gains, and you can see it by visiting arata.se/diamondhands.